Hey everyone, thank you as always for listening to the Above Board podcast. On today's episode, and as sometimes we do this is going to be a replay that you're going to hear from Michael Scott and co-host Matt Marcoux of this podcast. And this replay was something that we provided to clients last week, talking about the various outcomes of the tariffs. And you can actually fast forward to about minute 18 of this podcast to hear some more information on that. But I felt like this was a really great one to share. And we don't often do it, but from time to time we will. And I think everyone's hearing all this tariff news, all the uncertainty around that, what's going to happen within the economy, and certainly what's going on with the stock market as it relates to all of this. What's very interesting about this recording is the day that it was recorded, shortly after it was recorded, the administration came out and said, hey, we're going to put a 90-day moratorium on these tariffs. And then the stock market reacted positively. And since then, it's continued to be volatile. But what I can share confidently is, even though maybe some news has come out or things have changed over the last week, going through some of the different tariff outcomes, talking about the economics of what's going on, not only in the United States, but in the world, in this video and audio that you're about to listen to, I think it's very useful, and I think it's going to help you stay informed. So without further ado, we're gonna jump right to it. What I will share is this was a video format, so there'll be certain aspects that are referenced in today's podcast. If you'd like to view those slides, feel free to head over to our YouTube channel, and you can watch this episode on YouTube so you can see the slides as well. Without further ado, have a listen. Thanks so much. See ya.
Now, the purpose of today is to discuss our quarterly economic update, and it happens to just coincide with a tremendous amount of volatility that is happening in the market. Really, the purpose of these meetings is to show you what we do each and every week for our clients. So each and every week we have an investment meeting. We sit down as a team. We talk about where we're at economically. We talk about our clients' portfolios. We talk about specific cases that are coming up and make sure we're all on the same page with where things are. Now, again, the purpose of today is to use one of our core values of candor. We are here to deliver objective, non-biased advice. We will not be talking above you. We will not be talking below you. We're going to be talking right at you. What you will not hear today is our own political opinion. We will not be talking about our personal beliefs. Our job here is to talk about what is happening from an objective standpoint. You will also not hear the words from us, stay the course, because that is very heavily used in our industry. And it just denotes, don't worry about what's happening. It's going to be fine. Don't look at the news. And that's just not something we believe on. We believe in an active approach to our asset allocation. We believe in embracing that news and making sure that we have the right course of action for our clients. Again, what you will hear today is a fact-based discussion regarding our economic data, and it's going to come from multiple sources. We don't just look at one piece, we look at many of them. We have 3 items here on our agenda today. We are going to be very tight with time because we know how busy everyone is. The first piece we're going to talk about today is our economic update. The second is our portfolio composition update. And the third is the area of focus for each one of our 5 client types. If you're on this call or you're watching this, you're in one of 5 categories. You're either 10 years from retirement, you're 5 years from retirement, you're 1 year from retirement, you're newly retired, or you're comfortably retired. And we are going to give some outline for each one of those 5 areas so that if you're watching this and all we talk about is those that are retired and you say, but Matt, I have 5 years ago or 10 years ago, what does that mean for me? We are going to address that here at the end of our talk. So please make sure you stick around for that. All right, without further ado here, I have Mr. Michael Scott. He is a chartered financial analyst. He's our director of investments, and he's going to start our discussion today about the current economic landscape and the current political landscape, again, from a completely unbiased, objective point of view. We're going to use some pieces here that we have to illustrate our points. So we're not just, again, talking at you. We're going to have some pieces here that we can illustrate some of our points and some of the things we're seeing right now in the market. So without further ado, Michael, go ahead and take us away here, buddy.
Hey everyone, good morning. Like we started off here saying, we're going to walk through a lot of different things today. You're going to hear us talking a lot. If you have questions, the chat feature is live. Those questions will come to Matt and I. feel free to send them through. One of us will answer them as they come in, maybe at the end, depending on how time goes. But we're going to try and get through as many as possible today. So I'm going to start off, share my screen here, and we're going to begin to talk through the markets. And really, we're not going to spend a whole lot of time on where we came from because I know it's not 100% the same as where we're at today. But it's important to know the environment that we walked into our current situation with. So when we look at the first quarter of the markets, the S&P was down about 4% through the end of March. The Nasdaq down about 10, and the Dow Jones down a bit less than 1%. And by the way, these numbers are total returns, so we're including dividends here. And then the aggregate bond index was up about 2.78. At the same time as all this is going on, when we look at the economy wasn't actually doing so poorly as compared to the stock markets. So look at the unemployment rate. We were up at 4.1%. Now, what does that mean in terms of a historical average? Well, the past 50 years, the average unemployment rate was above 6%. It's about 6.1, 6.2%. So at 4.1, we're still doing pretty good as far as jobs are going. And that was confirmed in March with a job report of 228,000 jobs for March, with 150,000 jobs being added on a 3-month average. Now, that 3-month average has come down a bit, but we're at 4.1% on unemployment rate. Realistically speaking, we're running hotter than the past 50 years would suggest. And when we look at inflation, the February number came out to 2.8%. Now, that's about 0.8% higher than what the Federal Reserve wants at 2%. But realistically speaking, it's a lot better than the peak that we saw in June and July of 2022, where we were at 9%. So we're a lot closer to that target. But when we consider this, the economy is actually in a pretty good spot. It just wasn't necessarily being reflected in the markets in quarter one.
Yeah, what's interesting about this is on the right side of the screen, it's looking backwards, right? We're looking at last quarter or where we're at right now, but that data was from months or a quarter ago. And on the left side of the screen, we're looking at the markets, and the markets are more of a future indicator or what the markets believe things are going to be because they're assigning multiples to our stock value, right? If a company is trading at X, they should be trading at a multiple with where they believe things are going to be going economically. So it's really interesting. This page is the economy is telling us that looking back, everything is pretty good. The market is sort of forewarning us we might be in some rocky roads down ahead of us, and we are slowly seeing that over the last week or two.
Yeah, and we're going to hop into really this tariff discussion next, which I think all of us knew was coming. But that's really why the markets kind of got upset in the first quarter. Because if you remember, after the election, the markets kind of took off on this positive run up. There was hopes for their tax cuts, deregulation, and just some overall growth. But we get into February, and it seems so long ago now, but if we think back to February, that was actually the initial commentary on the tariff. So if taking you back then, you'll remember that Canada and Mexico were slapped with tariffs beginning in, I believe, the beginning of March, or they were scheduled to go in the beginning of March. We found out in February, and then the markets began to pull back from there. And we've had these conversations through March with a lot of you on this call. What were the markets going to do? We're okay with it pulling back a little bit, but what's it going to do in March and moving forward? And we knew that in April we were going to get the so-called reciprocal tariffs, and we knew that the market didn't have a catalyst to really go up until we got to that point. So moving into the end of March, this is where the markets were sitting. They were down a little bit, expecting some tariffs to come out. Since those tariffs have come out, we've seen the market pull back a little bit more. And that's kind of where the disconnect landed, because the issue was that the market was expecting something, it was forward looking, and the outcome was worse than what the market was seeing. So let's start talking a little bit about these tariffs here. And I broke this down into two sections, the why and the how. And like Matt said in the beginning, we're not here to be political. We want to talk about what the policy is. Whether we personally agree or disagree with it is kind of irrelevant. But let's let's talk about the why. And some of these whys are bipartisan, and a lot of us can understand them. We talk about unfair trade practices. What does that mean? Well, there are countries that do put tariffs on them. In preparation for this, I went through and I was looking and I was going to list some different countries versus countries' tariffs and different things. And you can go to the US government's trade website and look at the actual trade agreements, for example, with Canada. And sure enough, there are tariffs in excess of 200% on different types of dairy, butter, cream goods that go across the border. And there are different classifications on how that comes together, but many countries do have tariffs on the United States. Other countries don't necessarily have tariffs, but they have value add taxes. So if a country or a company imports something into that country, and then they manufacture it, they improve it, they do something to it, and then export it somewhere else, they have what's called a value add tax. They say it's not a tariff, but in essence, it does the same thing. They tax the improvement of the good. And we can agree that those two are challenging. And the third one here has actually been around a while. And this is actually not to not to pick on them, but this goes more towards the argument with the country of China, the Chinese, is intellectual property theft. Doing business in other countries, United States companies go there and other countries don't have the same intellectual property rights as we do in the United States. And we're seeing countries steal technology, and that's a non-dollar valued tariff, if you will, or a non-dollar denominated trade problem that are trying to be fixed. Additionally here, we have trade imbalances. And this one can be a little bit more confusing when we talk to the federal government. You know, for example, we buy a lot of goods that are manufactured out of Vietnam, and they don't buy nearly as much from us. And that is, generally speaking, okay and understandable when you think that we manufacture a lot of apparel there and their consumer base doesn't have the ability to buy as many things back from us. So there are trade imbalances out there. Can we correct them with tariffs? We'll see. But some trade imbalances make sense, some don't. And when we look at national security, this one a lot of people can understand as well. If you think about semiconductors, medicine, and manufacturing, a lot of this is manufactured outside the US. So we talk about semiconductors, they're in almost everything we have. A lot of semiconductors, especially a lot of the very high level ones, are manufactured in Taiwan. And, Taiwan is a staunch ally of the United States. The problem is that Taiwan sits off the coast of China, one of our biggest adversaries, and China thinks Taiwan belongs to them. And they just happen to be one of the manufacturers of something that we have in almost all of our electronics. It's a very big geopolitical problem. Now, we can discuss whether tariffs are the right way to fix that problem, but that issue is there, as well as medicines. Do we have the ability to manufacture antibiotics or different vaccines? We saw this come to the forefront during COVID with the COVID vaccines. We had to have them manufactured in large amounts outside the United States. We did manufacture some here, but there was not enough being produced in the United States to take care of everything we needed. And additionally, just other manufacturing that we would need if we ran into issues around the world where we weren't able to import for different reasons. So there are a lot of reasons why these tariffs are being put into place. Let's talk a little bit about the how. This is what's really confusing to a lot of individuals and to a lot of economists alike, is these reciprocal tariffs. They're not simply matching items good for good across the border. What the government actually did was they looked at the trade imbalances and then they calculated a tariff amount off of that. So the best way to describe this is actually look at an example. So the example of China here, China has exports from the US to China. So this is what we are sending the Chinese, is about $143 billion a year. What we import from China is about $439 billion a year. So you can see that we import a lot more than they do from us. And that's a trade imbalance. And that's one of the things that the president doesn't like. You can take those two numbers, subtract one from the other, and divide it by our imports from China. And that gets you to 67%. That is what the quote unquote tariff is that China has on the United States that you can see that the president was holding up and talking about. What they did is they said, we'll multiply that by a half, or divide it by two, and rounded it up. And that's how we got to 34% tariffs on China to begin with. And that's the math that was used for all the countries that we assigned tariffs to.
Michael, it really just sort of seems that the case for tariffs seems to rationally make some sense. It's probably more of the execution, and the far-reaching broad amount of them is what's really causing the markets to feel such uncertainty, and certainly some of those countries there too. So it's less about the why, because the why makes sense. The how, I would think, is where this ripping a Band-Aid off is what's causing so much volatility at this point.
Yeah, it's not even just the why. Sometimes when you have a mess, you have to frame it correctly to turn it into a problem, right? And we do have some messy trade going on around the world. We do have problems. Now, you look at a country like Australia, because one of the things not on here is that there's a 10% minimum tariff around the world. So a country like Australia actually has a trade surplus with the United States. They actually buy more from us than we do from them, but we put a 10% tariff on them. They are a US ally. They're a very important ally on that side of the world for us. Why are we putting a tariff there? Well, they don't allow the imports of US cattle and different things. Does putting a tariff on them make the most sense to solve that problem? I don't know that it does. And that's where we're running it into. And even if tariff was the right answer, is the amount right? And that's really a discussion that we need to have. And when you talk about far reaching, I'm going to show two charts here, and this is really going to show the far reachingness of this. So this is a chart from JP Morgan that shows tariff levels on an average basis from the end of March of 2025 going back to 1930. And it's really important to show this chart because we can look into the 30s and see that there were tariffs a lot back then, and we did use them, but they were on a vastly downward sloping trajectory ever since the middle of the 30s. There was an upward movement in post 2018, and you remember that we did put tariffs on different countries like China from the Trump administration, and the Biden administration left in place. There is some bipartisan movement on tariffs, and specifically, we talk about the intellectual property theft. For certain countries, that might be a viable option to deal with these issues. But when we go back and we say at the very beginning of our conversation, the market is forward looking. And the estimate on March 31st for tariffs was just under 8% on average. The reason the market is selling off so much recently was the actual tariff estimate that we got a couple days later was almost 3 times that, close to 25% across the board. And that's why we're seeing that rebalancing take place in the market, is because this was not priced in that way. The expectation was about 8, and we're getting over 25. And to get tariffs of that level, we have to go back to the very early 20th century, between 1900 and 1908, to get tariffs of that level. And you might be wondering, well, we did it then, here we are, why? Well, we also had an amendment to the Constitution around this time that allowed for income tax to be used. And prior to this point, tariffs were a big funding source for the United States government, but then we switched to an income tax, and tariff levels.
With all due respect, Michael, I really don't want to talk about income taxes right now, since I'm looking at this list here of all these people who are saying, Matt, have you filed my return yet for the year? No, great point. So much of it really is about the volatility right now is about a lack of uncertainty rather than the outcome that might exist. And the plan was for it to be somewhere 8 to 10, and in actuality, at least as it stands today, is closer to 25. So the question now comes is where do we go from here?
Yeah, and this is the difficult part because and this is where the uncertainty is coming from, is we're not sure. And I've got a couple outcomes on the next page, and these are not definite, but we'll walk through a couple of these. And number one is probably what's concerning to most people at the moment. If tariffs stay in place as they are indefinitely, it is hard to avoid a recession in that scenario. And before I say that out there, and I scare everyone by saying that, not all recessions are the same. This is not a 2008 situation where we have a global financial crisis and there's a whole different issues. In a lot of terms, this is self-done. We're putting these policies in place, and what we saw on Monday of this week is that can be undone with a tweet. And I say that somewhat jokingly, but the false rumor of a 90-day pause to tariffs took the market from being down 1,800 points on the Dow to being plus 1,700 points within 5 minutes. And then a following tweet saying that was fake news took us back down 1,200.
We were sitting there watching this. We were actually having this IPS discussion, this investment policy during that. We had CNBC up as we oftentimes as we talk, and we
Yeah.
actually had that. We were watching it together and sort of going back and forth with the whipsaw of the up and
Yeah.
down based upon what potentially could or could not happen.
Yeah, and that's what's key to say. Key to think here is if these tariffs stay in place as they are, it's problematic for U.S. consumers because at the end of the day, a company that's importing a good is going to pay that tax. However, that is most likely going to be passed through in some effect to purchasers in the way of higher prices. Now, we can have this conversation, is that inflationary or is it not? The reality is that inflation is key to a definition, and it's a rate of change. It's not a one-time change in the price level. So if these tariffs stayed in place at one level, they would increase the price level and then not change again, which lends it to be not inflationary. It's just more expensive, which we may be splitting hairs to everyone listening to us, but economic definitions. The reality is in that situation, goods become more expensive. We only have the same amount of income, which means we're going to begin to pick and choose what we want to buy. And at that point, there's going to be losers, and that's businesses going out of business, people being laid off, and that's how you slowly roll downhill to a recession. Now, I don't actually expect number one to be the case. I think a lot of us look at number two to being the true leaning of this. And I say that because when we think about the tariffs we've seen from Japan, we've seen from Vietnam, we've seen some South Korea, just to name a couple in the past couple of days, the desire to make deals. Vietnam came out and said that they will lower all their trade barriers to 0%. Japan wants to create a deal. South Korea wants to create a deal. I'd go as far as to say even the Chinese want to have a deal. Even though the Chinese have more economic might to argue with us over this, Xi Jinping has a mandate to keep his people employed. And if we stop buying Chinese goods in mass, there will be layoffs in China, much like there will be layoffs in the United States. And that's going to be an economic problem for him that he does not want to have. However, he has to appear strong for his people, much like Donald wants to look strong for the United States, which means a lot of those conversations are going to occur behind closed doors. That being said, I think most likely we see something like number two occur, where we see these tariffs lead to negotiations and the overall tariff level comes down. I don't think that goes down to pre-April 2nd levels. I think we probably do keep a certain tariff level on board across the board. Now, there are potentially these two other off ramps, and I think one is more likely than the other. Congress stepping in and removing the tariffs. Why can this occur? Tariffs essentially are taxes, and taxing authority is generally supposed to come out of the House of Representatives first. So the House could step in and say, we actually don't sanction this, and they could get pulled back. Unfortunately, the House is is very partisan, and there is a Republican majority at the moment. So the likelihood that that's going to happen is not high at the moment. When could that change place? Well, we're going to have midterm elections in 18 months, and people want to be reelected. If there is a recession, these tariffs are going to be looked at very strongly if they need to be overridden. The other piece that could come in is, does an organization or a state sue the federal government or the president over the tariff authority, and they say, you don't actually have the ability to do this because that resides with the House, in which case we would go to the Supreme Court for that, and the courts could potentially strike this down. Reasons why that hasn't taken place yet is because there actually is some support to tariffs across the board, and a lot of people want to see what could actually come out of this, what might actually happen.
Great overview, Michael. What an incredibly complex set of issues that we're sort of the pawns in right now. We are feeling it on both sides. How does this information then translate now to our client portfolios? Bring this down from the economic level to our client level, and where are we at right now with our portfolios?
Sure. So everyone's portfolio is different, first of all. And that's something that we have to keep in mind when we talk about this in this way. Everyone's situation is a little bit different. However, there are themes to everyone here. A couple things to keep in mind, and I know this seems probably what you hear on TV or you read, but it's factually true and makes it different, is that you want to have portfolios diversified. No one's portfolio, I shouldn't say no one, most people's portfolio are not solely invested in the S&P 500 or the NASDAQ or something like that. The reason being is that assets move differently. The S&P 500 is composed of the 500 largest companies, but of those 500 companies, there are ones that are growth and there are values. There are ones that are maturing, stable, hyper growth. Identifying the right ones within there or the right themes to invest with can help insulate a portfolio from feeling the full movement of the market. So looking at things like quality companies and dividend companies, value, international companies has led to better outcomes than just owning the index. And we flip that to the fixed income side, which is really interesting today. You want to focus on a high quality today. There is some concern, if these tariffs stay in place, what would that do to high risk of bonds? So when we look at the portfolio from that standpoint, making sure that we have a diversified portfolio. And for those of you that are listening today, you do have diversified portfolios, but I think even more so than having the diversified portfolio, the hard thing for people to do, even though they want to do it, is the quote, buy low, sell high, right? Like we all hear that in the markets. That's the ideal thing. How do you do that? Today, the market's at a low point. However, I'd argue that for most people listening, it's one of the harder points to buy, right? Because that's where the uncertainty is highest. That's why the market's low. So we utilize the IPS that we have for all of you and we've worked to develop for you. And we take that and say, let's look at a 60-40 portfolio. If we used our model from January 1 through the end of April 7th, that 60-40 portfolio would be about 56% in stocks and 44% in fixed income. Not everyone's portfolio looks like this. This is just an illustration. But because the markets have pulled back and the bonds have come up in value a bit, you're now off your IPS. And that IPS guidance gives us the direction to trim some of our bonds and buy our equities. That forces us and forces you all to buy low and really step into the market. Now, we're not stepping in with everything we have. We're not buying everything, but there are opportunities to buy that we did not have 2 weeks ago.
And this is why that stay the course mentality that is so prevalent in our industry is so antiquated. No, we don't stay the course. If today we are not at our investment policy statement allocation, we know without emotion, without bias, we need to make an adjustment. And again, that is just to bring, in this particular case, we need to bring 4% out of our fixed income, which has truly been the bright spot of the portfolio year to date, and bring that into the equity side piece. And we handle those rebalances right here in-house. And that's what we report to you on in each one of our meetings is where is the composition of the portfolio? This has also changed since the end of last year, right? We had 2 years of double-digit positive performance in the markets. What did we do at the end of last year for our clients? Well, we didn't just stay the course. We rebalanced out of that so that today we were not overweight in equities when the markets pulled back, but we're sitting right at where we're supposed to be. And now without any emotion involved, we can get this portfolio back to where it needs to be. And guess what? If it continues to slide, if it goes up, we make those small adjustments as opposed to large adjustments or wondering, is today the day to do it? We see how the markets are moving, and they're moving right now based upon news events, not really based upon fundamentals. So these news events, as Michael alluded to on Monday, moved to thousands of points based upon a piece of news. That's where we have to get out of, is today the right day? Is this the right moment? And look at it from a very objective point of view. And that's the hardest part of what we do.
And that's also the piece where I'm sure some of you are sitting back thinking, well, hey, like if these tariffs are going to stay for a bit, and if the market pulls back a little bit more, why don't we go to cash? Why don't we completely sell all of our equities? And it's because a tweet can change certain things. So rather than trying to determine how long to be in cash for or how long we have to wait something out, let's make these minute changes along the way. And that brings up a great point. Flash back to January, December, when the market's sitting at all-time highs, equally as difficult as buying low is selling high. And when that means that 60-40 portfolio is 63% in equities, that's also the time to trim and buy your fixed income. And it's kind of like, I like to make the analogy of when you wake up on a Saturday morning and you go outside and you see that your hedges look disheveled because they've been growing in different ways. Well, it's not always a fun thing to do, but you have to go out there and trim them and bring them back into order because that's the way we want the home to look. That gives us the best value for our house. We don't want disheveled bushes. So
we just got a great question here in the chat regarding rebalancing. And it pointed to, the question is, how often is this done? Mm-hmm. And is it weekly? Is it daily? Is it monthly with such a volatile market? And I think where the true answer to that on ours is it's truly rules based. It's when we move approximately 3% is where we're starting to look to make those changes. Now, that might not come from a global reset of the portfolio. We might change, if you're participating in your 401k, we might change where those contributions are going into and start really putting it into some of those areas that have pulled back. Sometimes it is a true composition change, but there is no today is the day to do it or let's do it every single week. We really look at that allocation page. If you're using MyPath, our online portal, and you're really looking at that page there, that is what we are actually looking at in our weekly meetings to determine how far. Now, some of it is a little bit of art and science. The art side of it states, well, things are in from some rocky road here. Let's just see how it looks and let's bump it out another week to see if we do that. But Michael, can you go to the very last slide? Because this one is really helpful in our meetings. So this is and you can describe this just like I can, but this is taking a look at the S&P 500 index. And the most simplistic way to look at this chart, and I show this in a lot of our meetings, is if you see the dotted line that states 1+ standard deviation and has a 20, can you just highlight that, Michael, the 20x line?
I'm not sure if I can highlight it, but it's 20.2.
That's perfect. So if you see that line there, anytime the market is trading above that level, it's trading at a premium against historical norms. If you drop down to the middle line there, that is the market is trading at fair value. And then below that is markets trading undervalued. You can see that point illustrated looking at the 2008, 2009, looking at 2020. And you can also see it conversely over in the 2000s and the dot-com bubble at the very, very top. Markets were trading at huge highs. So to answer the question here, really complex, is not just looking at when the portfolio needs to be rebalanced, but also looking at where are we at in the market cycle. And is the market right now trading at a premium or it's trading at fair market value? And as we've approached this fair market value line, for us, our antenna are up to begin slowly making the changes to that portfolio and to be able to look back on today and say action was taken. The portfolio dropped down below its IPS, its investment policy statement, and we need to make these adjustments upward. And it has less to do with the time factor as it has to do with it being on demand to where the portfolio is and where the market is trading at that time. Okay, let's transition here. We have 10 minutes left here. We promise to keep this very, very tight. We want to talk about for each one of those 5 client groups, where are we at and what should be focused on right now? So let's first start with our 10 plus years to retirement. 10 plus years to retirement, what should be your focus right now? You must be committed to staying to your investment plan. That what is happening right now, especially in regards to your qualified plan, your 401k, your Roth IRA, those are accounts you're not going to touch for more than 10 years. Guess how many more market cycles and ups and downs we're going to go through during that period of time? We're going to go through a tremendous amount. So that you should be committed to continuing your growth portfolio. You should be committed to maybe even increasing the amounts that are going into your 401k. And really, a lot of this is noise when it comes to that account. You know, John really said it best as we were talking about preparing for today. John Kennedy in our office, as we were talking through this, and he said, Matt, really the most important thing is to align your risk with your time horizon. And what we mean by that is that those accounts that have this very long time horizon, your 401k, your Roth IRA, that should be the riskier part of our portfolios. And our non-Roth IRAs or our non-401ks or our non-IRAs, just our non-qualified brokerage accounts, those should have a perceived risk far less than those, because that could be an account that you might tap into if you have an emergency or that you need. And so really, really strong sound advice is to align your risk with the time horizon within those portfolios. If we do end up going into a recession and there is changes in the job market, then you have less income for some reason, maybe that's time to consider a Roth conversion. Let's get out of some of those tax deferred accounts and put it into a tax-free account and be able to consider some of those things. And last but not least, assuming we have a nice, healthy savings account, we can slowly begin to put some of that cash to work, not because the markets are down, but because we just talked about a moment ago that we are more and more reaching fair market value of our equities. And it's not a bad time to put some of that cash to work. Again, you have 10 plus years to go. We are going to go through a number of these market cycles. So a couple things to consider if you're still off from retirement. Though, anything else to add on those, Michael? I think we kind of hit some of the major points for our younger clients, our younger group of clients here listening today.
Yeah, no, I think that all definitely makes sense. I think when we think about this, and I know it says 10 plus years to retirement, but even those that are in retirement or entering retirement, it's important to remember that though you're not working anymore, so we're not necessarily adding to the pile, that doesn't mean we're not going to have these market cycles then for you either. So,
Great point.
just as important as it is for someone has 10 plus years to retire, it's equally as important for those that are in retirement to remember this is probably not the last market cycle you go through. You're going to have more. So, I'm jumping ahead here and we're going to come back to it.
But don't
panic.
Jump ahead of me, buddy. Because we got the 5-year group, and we're getting more and more nervous as we get down to this group, right? The 10-year plus are like, we've seen this before. It's going to be fine. We have plenty of time. The 5-year group now is like, okay, hold on. I can slowly start to see that retirement is an option here. And of course, right now, we're going to go right into recession. It's going to set me back. However, you still have a long enough period of time that we're going to see some more of these market cycles. We want to make sure that that mixture is correct. And we want to slowly start transitioning that portfolio, not out of equities. That was really an old way of thinking as well. As we get closer to retirement, we don't want any stocks, right? No, we need that growth element for our longevity. We're not living to 50 and 60 years like we were generations ago. We're living to 80s and 90s, God willing. So we really need growth still to be a part of the portfolio, but we really want to start focusing on building income in the portfolio. And that's looking at our high dividend securities. We have a high income position that we have in some of our portfolios. We really want to slowly start getting less and less growth oriented and more income oriented for that. And in addition to that is if we want to have retirement early, we really need to make sure that our non-IRA account is really being funded well. The key to an early retirement is having not just a large 401k or a large IRA, it's having that plus having a non-IRA account that we could potentially tap into early. Or if you're on this call and we're doing Affordable Care Act planning, having that non-IRA component is absolutely critical. And if you have 5 years to go, you want to be funding that bucket of money as much as you can with keeping in line and having a good lifestyle. So there is that balance there. And again, looking at your HSA, if you're doing a health savings account, funding that max funding that and maybe not making distributions as you have health expenses, but trying to absorb that out of cash flow so that you have another asset to go after again down the road when health becomes more and more of an issue. So our 5-year plus are getting a little more nervous, but not as nervous as our 1 year to retirement. And I just had a meeting, and I don't see her on here, so I'm not going to use names, but I just had a meeting with a client 1 year to go from retirement. I met with her 2 weeks ago, and she was obviously a nervous wreck because now it's not just 5 years ago or 10 years ago. It's happening, Matt. Retirement is coming. And of course, right now we're seeing the world slowly implode. And I reminded her during that meeting is that this 1 year to go to retirement didn't come out of the blue. It's not a surprise, right? We have been planning for this. So we have been building cash positions. We have been making sure the 401k is slowly dialing back that growth and more income oriented because we need money coming in monthly. The growth of the portfolio is secondary to making sure that we have a monthly check being deposited into the checking account and you can live off of that. So again, our 1 year is dialing in those income, dialing those expenses in, and really getting ready. And if we've done all the pieces right up to that point, frankly, the market, what's doing in the market right now really should not matter because we know that dividends and fixed income are not really impacted by the movement up and down of the portfolio because dividends are coming from stocks and the fixed income is coming from the bond and the interest and dividends that are coming off of those assets. And those come whether the portfolio is up or down. Those are somewhat consistent. So our 1 year to goes are very rightly so in a place right now where they have concerns, but our job is to make sure we stick to the financial plan, which got them to having 1 year to go into retirement. All right. Newly retired. All right. This is they just hit the golf course. They're doing their trips. They're finally done with the rat race. Our biggest thing here is we've planned for this. Don't panic. Stick with your plan. In most of these situations, Michael, we have a large cash position, don't we, for these clients?
Yeah, I think one of the things that's key to a lot of times on how we plan is when we're approaching retirement, we have a great idea of what income and expenses are. And a goal is for those that are retired, whether they're approaching retirement in that 1 year or they're newly retired, to have something like 1 year's worth of cash on hand, whether that's cash in the investment account or cash in the bank account. 1 year's worth of your expenses is set aside. And the reason being is that gives us a buffer. If the market does go down in that first year, we don't have to touch the market to fund lifestyle. And then we also try to have a certain amount of years in bonds as well. And that's really where we get into like the risk spectrum. How many years worth of your expenses do we want to hold in bonds? Someone who's more conservative is going to have more years. Someone who's a little bit less and a little bit more growth oriented or risk, not risk averse, you may have less. But the goal is, it's not stay the course, like you pointed out, but stick to the plan. If we knew we're going to have these expenses, we've taken care of them for the next several years, continue to enjoy life. Don't necessarily panic about what's going on. We have this planned out already.
All right. And our last group here is our comfortably retired. These are our old souls who said, Matt, we've seen it all. We've seen the ups, we've seen the downs. Many of them had gone through COVID, retired, and really realize, again, the value of having a large cash buffer, the value in having a high dividend-based portfolio where that income is very consistent, and really being able to stop looking at the day-to-day movements of the portfolio, which you're retired now, stop watching this stuff, and really being able to rely on us as a team to make sure that we're reporting to them that income and cash flow are consistent and are sustainable through the rest of their lives. And we do that through our financial reporting. We do that through our MyPath report, where we're showing our cash flow, which is a live financial plan. I started this industry 23 years ago now. We would print a financial plan in a nice big thick binder and say, here's your financial plan. All you have to do is follow it. And what that failed to do was the moment that was printed, those numbers were out of date. The beautiful thing about the software and some of the technology that we utilize here now is that financial plan is a living, breathing document that changes every single day. Now, that is good in some years and not so good in other years to watch that. But what that does is it allows us to make sure that we have sustainable income for the rest of your life, assuming we stay within these income ranges and assuming we have a portfolio that is constructed the way that it should be, with the right amount of growth and the right amount of income present there. So our comfortably retired right now continue to be comfortably retired. We have a cash buffer in there in most situations that's quite large. And frankly, years like the last two where the markets run up a lot, that cash has earned 3, 4, and 5% versus the markets earning double digits. That was okay. That was intended and that was by design, so that we are here now where we're seeing a pullback. That cash buffer is doing exactly what we needed to do. Okay, Michael, we are at 12:45. We've been talking for 45 minutes straight. I don't see any further questions in here on our chat. So what I want to do is, again, thank every one of you for taking the time out of your day and hearing us speak. What we said today, you will be also hearing in your client meetings. We're not saying one thing out on a webinar and then coming in and saying something different. It's a consistent message, and that consistent message is to make sure that we have a plan for you and that we are executing that plan. And that plan should have no bias built into it. It should be completely objective. And that's our goal here with you guys. So thank you all so very much for being a part of this, for interacting with us on the chat. We are available one-on-one. We're available to talk via email, whatever it takes to make sure that you are comfortable and know that a plan's in place. That's what we do here at Candor Path. So Michael, any closing words for us?
No, I think you nailed it home.
Thank you all so much. Have a great day.